In this video, I'm going to explain the gap fill by spike report on edgeful.com. So here we're looking at SPY and we're looking at the trailing 1 year. So what this report measures is all the gap fills in the last year. How far away from the gap did they move before coming down to fill them? So don't worry, I'm going to explain with an actual example now. So this blue line here is the gap fill. You can see that this green area here, that is a gap up because of this green line. We opened above this blue line. So the blue line is just the previous day's closing price. So let's focus on this day here. Price opens here at 493.50, just about, and then moves up and away from this blue line. So it moves up and away. It's going away from the blue line. Then comes back down to fill this gap. So what you can see is this is the average spike on a gap up. So the average spike is 83 cents for SPY. So in this case, let's just measure this one. This is, wow, perfect, 81 cents. This is a spike of 81 cents. So this is like very close to the average. It will move away from the gap and then fill. So this report only measures all of the times where the gap has actually filled. So it takes the average. In this case, this is a perfect example. I didn't even realize, but this report really allows you to say, what's my expectation of the move away from the gap before coming to fill it? So the way that you can use this in your trading is to say, where should my entry be, or where should my stop loss be if I'm aiming for a gap fill, and how far away can price move from the gap before I'm like, all right, the gap's not going to fill today. It's moved way in excess of the average. So let's say that price had moved $2 away from the gap. Like it had moved this far away from the gap up until here. It's very unlikely that it's going to come all the way back down from here and touch and fill this gap. If it has that momentum to get up there from the open, it's probably not going to come back because the average spike is only 83 cents. So you can enter and you can have an expectation of a move away from you before it comes back to fill this gap. And then we have the same report, but for gaps down. So let me just invert this actually, invert scale. So then this would be a gap down here. So we open below and price moves downward and away from this blue line. So here the average gap down spike is 62 cents, so a little bit smaller. But that would mean that on average, price from the open, which is this green line here, will move 62 cents down before coming up to fill and touch this blue line. So this blue box here is the gap fill. It's just a highlighted box. I just put it there to mark where the gap filled. And this report really allows you to say, okay, like what's my risk here on this trade? If I want to enter near or at the open, then I know that on average, I should be risking somewhat close to $1 because historically price will move $1 away from the open before coming down to fill that gap. So that's how you can use this report in your trading. If you ever have any questions, just reach out to support here or just email hello@edgeful.com. Thanks for watching.